Hi, my name's Ben Bolger and welcome to the Expats, the platform educating expats to financial freedom. Welcome back to episode number 6 of our How to Invest series, and today we're going to tackle one of the biggest and longest standing arguments in finance, and that's active versus passive management. Now, for those of you that are not involved in finance or are relatively new to all this, you won't have a clue what I'm talking about, and there's no reason you would. However, by the end of this episode, you should fully understand the difference and will be able to work out which way suits you. Now, before we start, I obviously do have a preference, which will likely come through in this episode. But having spent nearly a decade in the finance industry, I've formed this opinion over years of reading articles, listening to industry professionals, attending conferences and so on. However, I want you to approach this episode with an open mind and encourage you to ask questions or share your thoughts at the end. This is how we learn. Just before we get our teeth stuck into this episode, I want to say a quick thank you to everyone who's been listening to this show and enjoying the content. If you haven't already, please subscribe to our show and leave a review for us, as we really want to reach as many expats as possible with this information. You could literally change a friend's life by introducing them to financial freedom. I want you to be that person. Okay, let's get down to it. So as I've mentioned, there are two main schools of thought when it comes to investment: active and passive. Now, active management is the more traditional and longer standing style. Active management is where an investor makes specific investments in the attempt to outperform the market. Now, I bet some of you are sitting there thinking, I always hear this term market and investments either beating or underperforming against the market. But what the hell is the market? Well, when investors or the financial press refer to the market, they're often referring to something called an index. A stock market index measures the performance of a number of stocks that are picked to represent a certain segment of the market. So common indexes that you might have already heard of are things like the S&P 500, which is a collection of the largest 500 traded companies in America, and therefore gives a good reflection of the economy and business activity in America. Similarly, the FTSE 100 is the largest 100 companies in the UK, and is a good reflection of the company and market performance of the UK. These indexes are moving during the day as share prices increase or decrease from daily trading investors. Remember, this basket is just mirroring the performance, and therefore, if lots of investors are buying these stocks, then it's likely to drive the share prices of these companies up, and therefore the index will mirror this. The same way, if investors have a negative view on the stocks, the index is likely to go down. Now, obviously, all the stocks aren't going to be moving in the same direction day to day, but what the index does provide is a constant aggregation and average of these stocks, which acts as an indication of which way these companies and the economy are generally moving. Now, going back to active investors, they will use the stock market indexes as what we call benchmarks. An active investor has the belief that they're able to beat the general movement of all these companies by usually picking a smaller number of companies than the index. Essentially, what these investors do, they buy the companies that think they're going to go up over a certain period of time and leave out the ones that they think are going to have negative performance. The way they do this is by lots and lots of research into the company and running technical models and analysis from everything from financial statements to understanding the management of a company. The idea is the active investor can use their knowledge and their expertise to focus on the winners and remove the losers. So for an example, an active investor who wants to invest in the US market might look at the S&P 500 and think, after doing my research, I want to buy Amazon, JP Morgan and Johnson & Johnson. But their research suggests that MasterCard, Netflix and Disney won't do so well and will decide to leave those out. The ultimate aim of an active investor is to outperform the index, so making more of the right choices to include the winners and leave out the losers. So in my example, by being selective over those companies, they hope to get a higher return than the average return of the whole S&P 500. You might have heard of some of the greatest investors in the world, such as Warren Buffett, Benjamin Graham, Ray Dalio, Charlie Munger and Sir John Templeton. These gentlemen have, for some considerable period of time, been able to outperform the stock index and deliver greater returns to the investor. Okay, so moving on to passive investment management. Passive investors believe that essentially that markets are too efficient and therefore it makes it too difficult to consistently pick the winners and leave out the losers over the medium to long term. And that's the key point here. It's really being able to do it consistently year in and year out. Passive management is a much newer concept and only really come to the table in the late 60s and early 70s. A huge advocate of passive management in the early years was a gentleman called John Bogle, more famously known as Jack, who later founded Vanguard and produced the first passively managed index fund. Jack Bogle and the passive management movement was created to express the theory and academic evidence that investors are really bad at being consistent at outperforming the market, and they would be much better at just replicating the market or in investing in the whole market rather than trying to be selective. The research behind this is that stock markets have historically always risen over the medium to long term. Yes, of course, there are small temporary periods where markets have experienced what we know as crashes or corrections. However, that is then followed by a recovery and then a boom. The market just recovers and then powers on forward. Like I've already mentioned on numerous occasions on this podcast, the S&P 500 index that tracks the share performance of the top 500 companies in the US has returned 53,641% since the beginning of the 1900s, which is an average of nearly 10% a year. Now, obviously that doesn't mean that you see a 10% increase every single year. That's not how markets work. You might get a return of say 20% in year one, 6% the next year, minus 2% the year after that. But if you buy and hold onto the index for the medium and long term, which you should be doing with any investment anyway, the more chance you have experienced those 9 to 10 average annual returns. So to recap, a passive investor is happy just to buy and hold the index, knowing that it will get a very similar return to what the market delivers. There's no human intervention or reliance on superior knowledge or market timing involved. As companies come into and drop out the index, they're just replaced naturally. For example, if a company was to drop out the FTSE 100 because of poor performance, then the next biggest company just replaces it. The index is self-cleansing and always evolving. And you're investing in the basket as opposed to the individual companies that make up the basket. One of my favorite quotes from Jack Bogle is, "Don't try and find the needle in the haystack, just buy the haystack." I think this just sums up passive management perfectly. Don't try and pick individual companies, just buy the index. The growth and popularity of an index style investing has grown significantly over the last few decades, with more and more investors happy just to track markets instead of trying to attempt to outperform. Bloomberg has recently reported that it expects passive management to overtake active management by 2026. Now, you might already be able to tell I'm a big fan of passive management, as for me it's a much more efficient way for you to reach your financial objectives. You don't have to rely on inside knowledge or market timing to get decent returns. You're basically putting your trust in the stock market and essentially saying, are the world's biggest companies going to be valued more as a collective in the medium to long term than they are today? And the answer has repeatedly proven to be yes. Now, I want to make it clear to you, there isn't necessarily a right or wrong answer in this debate. And if you do decide to get into this debate with someone with the opposing view, the chances are it's going to get quite intense. But like so many things I speak about, choosing which way you go, either active or passive, isn't going to be the defining factor when it comes to your pursuit of financial freedom. Remember, it's very unlikely that the diet, fitness, study, or business plan is the thing that lets you down. More often than not, it's our behaviours and our actions that determine our success. Next week, I'll be discussing what type of investments there are for both active and passive management, and why I really suggest avoiding picking individual stocks and instead using ETFs and index funds. Hope you found today useful. Please leave a comment and review if you did, as it helps us get in front of more and more expats just like yourself. This stuff is really important, and you'll be doing your friends and family a huge favour by introducing them to it. I want us all to succeed together. I look forward to seeing you all next week, and remember to always dream big.